Hello again, everyone. This is Mike Paulenoff, mptrader.com, March 14th, 2010, with your weekly video chart update. All right, I have a lot of ground to cover today, and I think it'll be kind of interesting. So let's just get through it, and let's see if we can get through it in 15 minutes or less. So perhaps there's some ideas afterwards, and you have your marching orders for the week, at least what to look at from my perspective. All right, the first thing on the screen we see is the Shanghai Composite on a daily basis, and the S&P, the cash S&P daily. This is a really bothersome relationship right now for me, and I just want to keep an eye on it. I just want to bring it to your attention because it is bothering me. Look, you don't have to be a technician to see what the story is here. You have the Shanghai Composite really making a series of lower highs and higher lows since August. Since it peaked back in August of 2009, and so nearly for 8 months or so, the Shanghai has gone nowhere. What that reflects, I don't know. It could be a lot of the internal situation in China, fear of higher interest rates because of an overheating economy. Who knows what else? In any case, I don't know what message the Shanghai is telling me, but it's telling me a very different message than the cash S&P. Let's put it that way. So this is a negative message. You can see the price structure here closed at the low on Friday at 3,013 or so. It looks like it wants to head for a confrontation with its flat, slightly rising 200-day exponential MA at about 29.95, 29.93. If that breaks, you're going to test this multi-month support line at 29, let's call it 29.39, and if that breaks, then basically this whole picture in the Shanghai Composite looks like a top. Now if I condense it, then you can see where it came from, and who knows where it could go, but it will be a drag and a destabilizing situation for the overall global equity market to see China's leading index break down. I don't know if it will, but I'm worried about it, and I don't know how it'll interact with the S&P and other leading country indexes. Let's look at the S&P. The S&P on February 5th, as we all know, pivoted to the upside and has taken off. It's gone up over 100 points since then, probably around 10%, maybe more. So the 10% up move in the S&P on the cash basis dwarfs the up move in the Shanghai Composite, which amounted to about 7.3%. Not only that, the S&P closed right at the high almost right at the high on Friday, at a new high on a closing basis, and the Shanghai Composite closed at the low of what has been a very difficult week for that index. So you have a real divergence here, and we'll have to see if one impacts the other. My suspicion is that it will. That the Shanghai, if it goes lower, will have a destabilizing effect on the S&P. But when I think about China, I think about a couple of things. One is trade, and another is commodity prices. It's the commodity price issue that leads me to believe that this chart on the Shanghai Composite on the equity side is telling us, maybe sending us a message about commodity prices, because China, maybe the Chinese economy isn't as strong as we thought. Maybe the Chinese economy is feeling the effects of all that stimulus and it's unsustainable. I don't know. But I know I have to look at this with a big cautionary sign. So from there, where should I go? I'm going to go over to the commodity side and see if there's anything on the commodity side that I need to look at. All right, here's the picture. Here's the daily chart going back, to about a year and a half. On the dollar index is the top chart, spot gold prices second chart, and crude oil prices are the third chart. Now, when the dollar's going down, as you might imagine, gold had its big run to the upside. Oil went from $47 to nearly $85. But after the dollar bottomed in November and started its up move, gold had a problem, which is not unusual with the dollar rallying. Oil is having a problem. Now, oil's held up relatively well, but look, keeps topping out at around the $83, $84 mark. With that in mind, last week it hit a lower high of 83 and change, and it turned lower on a reversal. So we have to watch what's going on with these commodity markets. If the dollar stays up, that will be will have a detrimental impact on the commodity markets. And what about the Nikkei? I'm sorry, the Nikkei. What about the Shanghai? All right, let's roll the Shanghai index in here. All right, so now we have the dollar. We have the Deutsche Bank Commodity Index, which is mostly metals and oil, and we have the Shanghai Composite. Well, this is let's just identify when the dollar started going up, what happened to the other indices. All right, dollar starts going up, in late November. The Deutsche Bank Commodity Index held up, but peaked in January, and it's been going down since then, and it looks like it's rolling over. But very interesting to me is that in November, December, the Shanghai peaked, and it started to roll over, and it looks somewhat similar to the Deutsche Bank Commodity Index. So it could be that we're having a double whammy for commodities now, and we have to be very careful. We have on the Shanghai Composite side, perhaps China's economy is not as robust as everyone would like to believe, and the procurement of commodities will take a hit, and that in turn means that the demand side of commodities may not be all that bright, and so the Deutsche Bank Commodity Index is starting to roll over. So we have to be this is really interesting. We have to be really careful here that somehow all that stimulus for the past year and a half maybe has worked its way through the system. We've seen the benefit of it. We're getting the highs now in the U.S. We already saw the benefits, the anticipated benefits of it in China, and now we're starting to roll over in China, which also will have an impact on the commodities themselves, but also the commodity names in equities. All right, so we've identified what I think is some areas to watch, some areas to look at to see the interconnection between on the macro side of the markets.